Today is Wednesday, 22nd of July, 2026. My name is Francisco Gaffney, and this is my daily streaming all about governance, risk, compliance, and advisory boards. So, continuing with this week theme, the focus is to bring the value creation system from the advisory board perspective and how it can help bring light to where the company is drifting, spot accidental scale, build a capital stack that supports growth, and put systems and operating controls, particularly for resilience. So yesterday we spoke about scaling and the quality of growth. And today we are moving to the right-hand side of the advisory board operating system, which is growth and capital, which is the predictability. So the partnerships, the revenue, and the assets. Let me highlight the model where we are going to talk today. But particularly today, I'm going to talk about the quality of capital or the capital stack. So it's not specifically listed as part of the legs on the model in terms of partnership, revenues, and assets, but is specifically about capital. And here's where the value creation starts, because you have two options here. Or the capital drift the company and you're subject to the capital dictation, so what the capital dictates, or you engineer the capital to work for you, the company. And this is a two concept. Actually, we'll say, where's that coming from? Well, this is engineering capital and finances, which is not many often, or it's not often discussed, but I wanted to bring it together because this is very important. This is where many companies get caught and they do not design a capital structure, right? And let me explain this. What many companies do is inherit one just because of the people that they managing the finances, or because of through an acquisition is whatever they inherit from the prior shareholders or owners. So a bit of debt here, a bit of equity there, a rush facility because the market turned at one point, right? A refinancing date that looks far away until all of a sudden we are and do deadlines now. Or one is, and the one that is not seen a risk, but can be turned around very nasty, that not many people are aware of, is a shareholder right that looked small at the time that you agreed, but later shaped the next move of the organization, the whole organization. That is a nasty one, and is hidden, lurking in the background. And if you're not careful, these kind of things are part of the capital stack that actually you have to be aware of. So this is a capital problem. So what I'm trying to say is a weak capital structure does not usually fail in one dramatic moment, like all of a sudden bomb collapses. It fails quietly. It narrows your options. It weakens your negotiation positions. It makes management serve the capital stack, as I mentioned, instead of making the capital stack serves the business. Now, let's take a look at three problems with this. Problem number one is timing. The capital does not reward panic, and probably you already know this at this stage. It rewards readiness. If the board or you as a founder or the executive team waits until the business needs money urgently, the company is already negotiating from a very weak position. And many times that weak position means no or a big discount, meaning that it's going to cost you a lot, or is going to be very, as they call it, very expensive money. Now, problem number two is a false comfort. A good market window can close very quickly. So a funding route that looked available last quarter may not be available this quarter. And boards that wait for the perfect moment, will never is perfect, often discover the moment was not waiting for them anymore. So they have to go again to a discount or very expensive funding routes. And problem number three is a structure drift. So the company adds funding instruments without looking at the full picture. This is what I mentioned at the beginning. Debt changes pressure, equity change ownership. So you have to decide which is a better route, debt or equity. But one or the other have different in the scale. You have to scale that what is one, because if you change ownership with equity, then you might have the capital now but at the end the decisions are not yours anymore, or could be is a battleground all the time. And this is probably a bad word to use, battleground, but sometimes it feels like that you are against a wall because the interest of equity are not the same interest that you serve with a debt. With the debt, you pretty much owe, you have a debt, so you satisfy that debt, and pretty much the control of the company, the ownership is still with you. But the other way around could be very difficult in terms of human relationships, trust, etc., etc. Meaning control rights change who shapes the next move when you put equity as a part of the capital stack rather than a debt. So if those are not discussed very, very clearly at the very beginning, the funding becomes a hidden strategy that actually can collapse in the future. Now, I have an image to represent this, because actually, if you imagine this as a keel of a boat or a vessel, this is what it looks like. In in calm waters, the capital stack is let's say there's a keel of a ship. You barely notice any changes in calm waters because actually it's very balanced, it's very pleasant navigation, etc. But when you have or you are in very rough waters, you find whether it was designed properly or not, the capital, because the keel pretty much is what it gives the balance of the boat, and help you to navigate these circumstances, right? So if you don't have a very good balance with a very good and solid keel, that probably is going to be a problem in the future. So you have to be prevent these kind of things. Let's go back to the model, and I'll continue explaining a few things. As a board advisor, what I would propose to consider is the following. First, separate the capital question into three parts, right? Debt, as I mentioned, debt, equity, and control. Debt changes the pressure, right? Equity changes the ownership, and control changes who gets to shape the next move, right? So you might have debt with control, but you might have equity without control. So that will shape the next move. If the board or you as a founder or your executive team talks about funding without splitting those three apart, it's I think the Tolkien is too loose. So you have to make sure what exactly of these three things are you talking about. So you need to put that into your advisory board, into your executive team, and yourself as a founder to think in which terms are you going to go further. The second is the scenario test before fundraising. And this is very important. Ask what happens if revenue drops. What happens if the next round slips by 6 months? So you might have everything in place, but actually things start to slip. Like it could be anything, holidays. Like in Q1, we have a war or a problem in the Middle East that changed everything. Or what happened if the cash collection slows, right? So perhaps the fundraising was right, but the cash collection slows, so that you have now interest to pay, you have capital to repay, etc., etc. So what will happen? As what happen if the lender adds tighter convenience? So you might start to negotiate, and then the convenience start to get tighter and tighter, and say, "Oops, I really want to do it," but then you have to put a stop somewhere of how much you're going to agree or not. And that's what happened if the investors want rights that look small today, but strategic later. So sometimes this is a hidden negotiation thing, It's a hidden trap that many times with capital, that you really start to engineer what the shareholders or the rights in terms of equities are putting strained in the future of the organization, or actually you can work with them. And the third thing to consider is make the governance visible. Capital is not only a finance decision, it is a governance decision with a legal and strategic consequences, right? So just look at these very, very carefully. The board, or you as a founder, or the executive team needs to know who can approve what, which terms change controls, which rights matters, which dates create pressure, and which funding route supports the strategies. This is where an advisory board helps, right? And there's a reason why, because if you as a founder, CEO, or CFO, or the board, you're too close to that pressure, you're too close to the things that you have to do, and sometimes these eagle-eye vision is required, and an advisory board helps here big time. So the internal team may be focused on getting the money in, that's correct, but the advisory board can slow the conversation down enough to ask a few questions that are very important. And it's not to delay things, it's just to make sure that actually you're not compromising the future of the organization with something that you need right here, right now. So question might come in the form of, is this funding supporting the strategy or distorting the strategy, right? So you might say, well, yeah, we need the funding for X, Y, Z reasons, but in terms of the strategy, how it sits. So the other question might be, does this instrument give us a runway or create a future constraints? So you might have, like, you're running into literally a two-lane road into a one-lane road that creates a lot of constraints in the future. Are we protecting control or giving it away by accident? That's another question. We mentioned this between debt and equity. And do we understand the next consequences? Right? So be careful with these questions and consider them, at least consider them. So those are practical. So they also fit with the advisory board operating system model that we have in front of us. And remember that this week, the focus is how we add to the valuation of the company from the advisory board perspective. This is not to put more challenges, is to how we create value and protect value from the advisory board lens. That's why from that lens of value creation for the company, predictability is not only about forecasting revenue, it's also about knowing how growth will be funded, what assets supports it, and which choices the capital structure creates or removes, because sometimes it removes. So what do you gain working with me? Three things: business outcomes, differentiators, and risk reduction. In terms of outcomes, is a capital moving from a scramble system to funding supports that growth instead of distorting the future, right? So the differentiator is a rotating international advisory board. It brings finance, investor readiness, governance, strategy, and growth capability around the milestones, faster than hire one executive, which are very good ones, but they're very expensive and take too long to hire them, or a lower overhead than a big consulting firm, and not talent locked in. And very important, because you don't want to be with the same people, advisory board all the for many years. It could be possible, but actually, if the company strategy change, you have to look into new members are more precise and accurate, or more better fit for that next milestone. You might change one or two members, and we have the capacity to do that. So the risk reduction is a capital drift. Members can be changed, as I mentioned, every 6 months as the projects evolve. So the business is not stuck with the wrong structure, cost, or bias for too long. And this is very important. You want to avoid any bias. Now, another small drawing for you, illustration of how to, we went to our key illustration. This is a one-pager capital map, and this is very important. This is one action you can take, and it's doable today in 30 minutes or less. So before your next meeting with yourself, with the founder and your executive team, your CFO, your C-suite, or your board, ask for or do this one-page capital map. Show every funding instrument, every key convenient shareholder rights, every refinancing date, and the one decision each instrument could constrain your organization. So if this page is hard to build, the capital story is already too fuzzy. So you really need to look into this, not as a painful exercise or as a punishment. You have to look into this and say it's an eye opener. So these are very, very important titles, like convenience, shareholder rights, refinancing dates, etc. So these are very, very good pillars to think about how your capital map is structured and what you can do about it. So let's pause it here for today and reconvene tomorrow, because tomorrow we move into controls and resilience, because the capital only stays useful when the system underneath the business can absorb shocks without breaking. You might have a very well-funded organization, but if it cannot absorb the as they mentioned, the rough seas of the business, then the capital cannot be very useful. Now, if you're a founder, as I mentioned, a chair, non-executive director, or in a C-suite, and you want an international advisory board to design stronger capital structure around growth, control, and timing, let's have a 30-minute call so I can understand where you're coming from, where you are today, where you would like to go, and after understanding this, what is your position, where I can show how or where the predictability milestone starts and how we can help. Have a great day, and I'll see you tomorrow. Thank you, and bye-bye.